what's confusing me here, and you're going to have to shed light on it, is the fact that this meeting, these minutes, came out on January 31st. This was the meeting, and that was before we actually got the signs that we are looking at a heat up. The CPI came out a week later, and the wages number came out a week later. So these minutes, I don't know why they're even important, because it was before the actual news.
Well, the Federal Reserve has indicated, and some of the presidents of the Federal Reserve regional banks have started to indicate the economy may be, quote, overheating. Right. And they got to drive the economy like you do an automobile. It's preposterous that they can guide the economy, think they can guide the economy. But that's what they're going through their minds, and that's what weighs on the market. So even though the economy shows real signs of picking up steam, they worry. Markets, as you know, anticipate the future. Are they going to do something crazy down the road to hurt the economy? That's what got the markets worried.
And to your point, Maria, about the timing of the minutes, it's, you know, almost because of that the inflationary pressures, if they're there, that came out in those events that you talked about afterwards, would lead you to believe that maybe the minutes were not as dovish as they really are, because then you have inflation building in afterwards. So early in the afternoon yesterday, when people say, well, you know, maybe the Fed's not going to go so crazy here, then afterwards they start to think about what you said, and they say, well, maybe they'll have to.
Or maybe the
idea a change in sentiment.
That the Federal Reserve is under new leadership, concerns there, and just not in control of what is going on with interest rates. In terms of, again, I know we have this chart, but you see bonds fall and stocks fall. The 10-year yield hitting a fresh 4-year high, getting very close to 3%. That goes right to what are stocks worth in this environment? We came into this year with risk appetite at record highs and valuations based on a lot of metrics at all-time highs in terms of looking at all the median valuation of all stocks that are traded in the United States. And you've got a lot more supply. By the way, this meeting was before that reckless spending bill pushed through by the Republicans.
Too. Before that as well.
And that's going to juice growth even more, and that's going to drive up the amount of supply of treasuries that are being pumped into a market at the time that a ready and willing buyer over the last 8 years is stepping back, and I'm talking about the Federal Reserve.
Yeah. Do you worry about yields where they are right now?
No, I think the key thing is that the Fed indicates that it's not going to try to guide the economy, but let borrowers and lenders determine what interest rates are going to be. That would be a good thing. So how the Fed describes what it's doing is going to be critical. If it indicates it's going to try to cool down an overheated economy, fight inflation or something like that, then the markets are going to be very, very volatile.
Does 3% matter, I wonder? As, you know, we put way too much into psychological numbers or round numbers in the stock market. I'm sure we probably do maybe in the bond market, too. So.
But where rates are headed, just look at what's happening in mortgage rates. The 30-year, 4.6%. Boy, that's way above the 10-year.
That's true.
And higher interest rates on credit cards because the Fed has been raising short-term interest rates, higher rates on a number of different consumer loans. So that does put pressure on the consumer. But, Steve, if we're finally having organic wage growth in this country, you don't want other types of inflation to eat into that. So it is the Federal Reserve's job to make sure that inflation in other parts of the economy doesn't get away from itself. Because, again...
Well, the key thing there is look at what happens to commodity prices. The early part of the 2000s, the dollar was weakening, so we had a phony boom in commodities. It was the weak dollar, not so much demand for commodities. And so the key thing here is if you look at, say, the gold price as a proxy for commodities, if that is stable, then you don't have to worry about overall inflation. And they've got to make a distinction between wages going up because people want more workers, and then that spurs productivity, that spurs investment. So I think the Fed should just step back and say, let's see what the economy does. We're not going to pump the dollar up. We're not going to pump it down. We're going to stabilize it.
But are they going to do that? That's the whole point.
Well, that's why you got this volatility. They don't know. The Fed doesn't know what it's doing.
You don't know. You don't think the Fed even knows at this point?